everyone. Long time no see. Welcome back to the Bird Traps Report TV. Today we have once again Robert Van Battenborg, CFA, longtime friend, longtime contributor from our team in New York, and also our CEO and founder, Larry McDonald's. Hi, guys. So, as you can see behind Larry, you can find our Bloomberg live chat. We have a live chat with more than 660 investors, and there's a topic that has been going on today, which is the mysterious bid in the equity markets, under the surface. And I want to hear your guys' opinion on what's going on. What are you hearing today? What's going on, guys?
Thanks, Valentina. And what's great about the chat behind us is it's an institutional chat with about 600, 650 professional investors. They're buy side, pretty much only on Bloomberg. And from time to time, we gather intelligence. We're crowdsourcing intelligence. And over the last couple of weeks, there's been more and more clients talking about, as Valentina said, a mysterious bid under the surface. What's really going on here? And oftentimes during holiday months, holiday shortened weeks, you get a lot of games, a lot of people are heading on vacation, and there's a lot of manipulation that can happen in the markets. 4th of July, the Christmas, pre-Christmas, pre-Thanksgiving. And Rob's onto something. He's been gathering intelligence for the last couple of weeks. He pointed this out to our clients, Rob. I think, Jose, if we could pull up the first chart, but the gist of it is, Rob, people are essentially trying to front run the JP Morgan, I guess you call it a call star. What's the best way to explain that to a broad audience to make it understandable?
Yeah, so there's a JP Morgan hedged equity fund. It's a mutual
fund. The hedged
fund.
Equity fund.
Yes, the symbol is J as in John, H as in Harry, E as in Edward, Q as in and X as in Xavier, JX. And that has now $17 billion of assets under management.
17 billion.
Yeah, 17 billion, one of the largest funds out there. And what it does is basically buys the S&P and it sells a call above it and it buys a put spread below it. So the thing is that in this case, it's hedged. So people who invest in the fund are comfortable with the idea that if the market falls out of bed, goes to zero, it doesn't matter because they have put underneath it. So they're hedged, but they give up some of the upside because JP Morgan funds that with a selling of a call. And that also provides the investor with an above average yield, so a higher stream of income. But the price they pay is that sometimes some of the upside, especially in strong quarters, is given up because there's a call above that fund.
Okay, so let's break that down just for, I just want to make sure I understand this for a broad audience. So this is a product that is sold by financial advisors to high net worth individuals, to investors, where the upside is capped. In other words,
yes.
The downs. So you're kind of a caller. It pays nice income because they're selling upsides. They're selling upside calls, but over time, the more and more and more and more and more money that comes into this fund, like you said, now it's 17 billion. I suspect it's becoming harder and harder to manage. And are people trying to game the fund, or are people trying to front run this situation a year end?
Yeah, because it's basically gone. Remember, we have heard these stories about Madoff back in the days that he would sell a call and sell a put around the S&P and generate these returns. And then this accountant in Boston, Markovich or something like that, he basically did a study on it. And he said it would not be possible because the market would be so overwhelmed with the enormous size of his fund that, it would basically collapse the opportunity of selling options on top of and below his fund. So it's a little bit of what's happening here, but this is obviously legitimate, unlike Madoff. But it's a little bit what's happening here. It's become such a beast in the market that every quarter they have to roll their position into the next quarter. So they have to sell another call on the S&P and they have to buy another put spread. So when the fund was in the hundreds of millions of dollars in assets, nobody paid attention. But now it's 17 billion. So
and what's the name of the fund again?
the JP Morgan Hedged Equity Fund, JHEQX. So every quarter they have to roll this call, they have to buy back the call that they sold a quarter ago, and they have to roll it into a new call 3 months forward. So on December the 29th, they have to buy back 41,000 calls on the S&P 500 that they sold with a notional value of $17 billion. They have to buy that back, and they have to roll it into a March 28th call, about 5% above the market. The rolling means is they sell that call and they buy back the call that expires December 29th. Now, the option markets, they're no dummies. So they see JP Morgan coming on December the 29th. They cannot buy it on December the 28th. They cannot buy it on December the 30th. December the 29th, they have to buy back that call. So the open interest that JP Morgan, when they sold this in September, on the end of September, was 41,000. They sold 41,000 of these calls.
41,000 contracts. 41,000.
41,000 contracts. It's immediately, right now, it's going up to 83,000 contracts. It's a notional value of $37 billion. So what we read here is that speculators are front running the JP Morgan roll. They're buying these contracts because they know that JP Morgan on December the 29th, not a day later, not a day earlier, they have to come in and buy those calls. And that front running is kind of pushing up the indices as well. And that's a very interesting development because we saw the same thing happening by the end of June. Same story. There was different strikes, but it was a June expiry. JP Morgan had to come in on June the 30th and buy back the call. They sold at the end of March, and it basically pushed up these indices into this inevitable roll. And that's one story that is out there. And because it's so big, there's no call or put in the S&P. If you look at each and every single option line that has absolutely near the open interest that this call has. So it's the big kahuna in the option market. And it's as we go closer and closer to this December 29th date, it's going to probably play a bigger role here because.
Okay, so let's go through the strikes again. So right now the S&P is at 46.19, and this contract is struck at 45.
Well, it's a 45.15 that they sold for about $45 back in the end of September. So if they buy it back today, they'll pay $120 for it. So they're looking at a loss of about $300 million on this position. They don't really care that much because they're going to roll it into the March. So they're going to get money as they sell those March calls. Although I have to confess that the March calls are a lot cheaper on the same strike than the December calls. So there's a premium differential here. But nevertheless, it doesn't really matter. They will roll it, but there's people that are going to make a lot of money out of it because those people that have been buying those calls feverishly in the month of November, and they're sitting on huge gains right now, and they know that JP Morgan is going to come in and buy it from them.
Okay, so JP Morgan comes in on the 29th. Walk us through what they have to do.
So JP Morgan comes in on December the 29th. They're going to have to buy back the December 29th call 45.15, no matter what the price is at that time. At the same time, they will sell a call on the S&P 500 that expires on March 28th. Roughly, their goal is to sell 5% above the market. So I suspect they're going to sell a call, which is at 4,800, with a strike of 4,800, which is now doing about $65. So they'll sell 41,000 March 4,800 calls, and they will probably accumulate a premium of $65 per call. So that's 41,000 times 100 times 61.
Jose, can you bring up the next chart? We'll take a look at the tech tech stocks versus commodities. This chart speaks to what's going on in terms of on October 28th, October 29th, the NASDAQ 100 valuation was about $16.3 trillion. Today, we're up to $18.6 trillion. And we're going to talk about the equity space in the energy patch pretty soon. We're going to get into some things in the next segment. But I just want to bring up here, as you can see here in this chart, I think it's one of the most incredible charts, and it points to, there's a scene in our book, a major scene in a couple of chapters where we talk about the valuation of the energy sector versus the technology sector. And here's, I'm going to bring in Kavi. When Markets Speak, coming out in March. It's absolute blockbuster book coming out in March, When Markets Speak. We've got some incredible endorsements, which from major celebrities, and we've really worked hard on the book. But one of the things we talk about is in 2014, the energy space versus the NASDAQ 100, there was only about it was about 600 billion between the two. So you've got on that lower right-hand side, you've got $4 trillion was in the NASDAQ 100, 4 trillion. And then the energy space was worth about 3.4 trillion. So that's about $600 billion spread between the energy stocks and obviously the technology stocks. Today, that's now come up, that spread is now approaching 16 trillion. So we've gone from $600 billion spread between the NASDAQ 100 and the energy stocks, and that's the MSCI Global Energy Index, and the NASDAQ 100. And you're talking about almost $16 trillion. And so our main thesis of the book is we're coming into year end. There's a lot of games around, there's a lot of stocks that have gains. People might sell those in the new year, which we've talked about in the past. And then, but your hard asset parts of the market are very, very underowned. And as inflation proves itself to be more sticky, we face a potential colossal rotation in 2024-25 into more hard asset plays. And as you can see here on the bottom part of the screen, the entire energy complex right now, Rob, is only worth 2.6 trillion, and whereas the entire entire tech patch in the NASDAQ 100 is worth about 18.6 trillion. So 18.6 trillion versus 2.6, that comes out to close to $16 trillion spread. And Rob, what we're going to get into in the next segment is the energy stocks have been weak at year end. You could get another M&A cycle. Energy stocks are very cheap relative to the NASDAQ. Energy stocks are a very small component of the S&P relative to the NASDAQ equities.
Right. Yeah, so we saw today a deal where Occidental is buying a private company in the Permian. So that is a deal that essentially demonstrates how Occidental wants to get deeper into shale domestic. The size of the technology in the overall S&P, the overall U.S. equity market has become so astronomically.
Yeah, walk us through the real size. Like, people don't understand because of the consumer discretionary and the communications all in. How big is technology in the S&P?
Right. So if you look at information technology, it's 30%. If you look at communication services, it's 10%. So that's already 42%. It's like communication services, people think, oh, that's AT&T and Verizon. Well, not really anymore. It's probably dominated by two heavyweights, which is Google and Meta, formerly known as Facebook. So, and then you have consumer discretionary. That is another 10%, but that again is dominated by Amazon and Tesla. So there's an enormous weight in tech lead, it's tech heavy sectors that has led to an adulteration of a number of sectors, and they're now a fraction of weights. Energy right now is about 3.9% of the S&P. Materials are about 2.4% of the S&P. They're more industrials, 6% of the S&P. And this is one of the hallmarks of a bubble, right? When you have so much capital going into so few stocks and so few sectors, it basically saps money out of all the other sectors. And this is not
So let
something
me,
that is.
so Apple's close to 7% of the S&P, and the entire energy space and the entire material space is, in terms of the S&P, is less than Apple.
Yeah, yes, exactly. But it doesn't, it's not only what's happening in the stock market, it's happening within the broader economy as well. Because if you have so much money going into one specific sector or connected sectors, so you have technology, communications, services, as well as parts of the consumer discretionary, that capital is a scarce resource. So it avoids, it gets sapped out of all these other industries. And the result of that is that these industries become non-competitive. They can't compete anymore. Classic example is, of course, the steel industry, right? Up until the 1970s, 80s, the United States steel industry dominated the world. Now there's virtually no integrated steel company anymore in the top 40. So that the country is almost completely reliant on foreign sources of steel. The biggest steel maker in the United States, integrated steel maker, is foreign owned. It's Mittal Steel. We can go down the list. Automotive is another textbook example. More and more of the industrial economy is essentially relying on foreign resources. Look at all the battery makers. Besides Tesla, all the other battery makers are Asian. That's part of the industrials. So that's a very tricky system. People may cheerlead, maybe people may be glad, they may be exuberant about the enormous gains in technology and the size of some of these companies, but it goes at the expense of something else, because it goes back to what we said before. Capital is a scarce resource, so if it goes in one thing, it can't go into another. So that's a very interesting development, which leads to ultimately to many industries becoming non-competitive and being marginalized. Ultimately, that scars an economy, because once the bubble bursts, then you're sitting there with capital losses, and you look back and who knows, maybe you made some money or lost some money, but those industries are gone forever.
And that's like, there's a scene in our book with a great quote from Larry McCarthy, and it's like, famous trader, junk bond trader, one of the top junk bond traders in the last 30 years on Wall Street. But his point was, higher prices bring out buyers, lower prices bring out sellers, size opens eyes. And this is exactly what's going on. The higher prices are bringing out buyers at year end. The lower prices in, say, energy materials are bringing out some sellers, some tax loss selling going on in there. And you just have like this incredible divergence, as you can see on the screen. We'll kick you back to Valentina. Thanks very much for this segment. And stay tuned for our energy segment.
Thank you, Larry. Thank you, Rob, for such an amazing conversation and such insightful information. Guys, remember you can pre-order our upcoming book, How to Listen When Markets Speak. You can find it in the link below. Also, you can reach me out at valentina@thebirdshopsreport.com. That's valentina@thebirdshopsreport.com. For a free trial, I can offer you 21 days. And I want to wish you a happy holidays to everybody. See you next time.